Welcome to Within the Frame, where we bring the most pressing issues across the globe into focus. I'm Kim Mok-yeon. The renewed conflict between the United States and Iran is once again putting the global economy on edge. Oil prices have surged on fears of supply disruptions through the Strait of Hormuz, raising fresh concerns about inflation, just as central banks remain on high alert. Here in South Korea, the BOK has resumed raising interest rates, while President Lee Jae Myung has signaled that the government's fuel price cap could be extended or even strengthened to help contain rising energy costs. Now, despite the uncertainty, Korean stocks rebounded sharply today, with investors also turning their attention to the upcoming U.S. tech earnings for clues about the outlook for AI and semiconductor demand. So how worried should we be about the economic fallout, and what should we be watching next? For more on this, we connect to Shin Se-don, Professor of Business and Economics at Sookmyung Women's University. A big welcome, Professor.
Good evening.
And also joining us in the studio is Song Soo-young, Professor of Business and Economics at Chungang University. Good to see you, Professor.
Thank you for inviting me.
So, Professor Song, let's start with you first. So, like I've said, the renewed situation between the U.S. and Iran, it has pushed the Brent crude back above the $90 per barrel level. How serious do you think is this risk to the global energy market?
Yeah, the exact number is not $90, it's $89.99. So it's a future price, but recently the dealers in the crude oil futures, they focus on they do not think it's going to be a bullish price increase for the upcoming days and weeks and months because of the Trump, the uncertainty and the Trump's such a big swing of a policy against Iran. So just we have seen that such a shock. Therefore, the dealers are very cautious and they just focus a very short run and the short-term change of the price, so they do not make any bet. So the lot or the futures the transaction account has remained within a lot. The trading unit has been reduced to very low level. So I think also another very big issue is because China, they have dramatically reduced the import of the crude oil. Of course, because China has continued their electrification of the whole infrastructure economy, that actually reduced the demand for oil. Therefore, as a result, the oil shock is not as big as it used to be, but I believe this will not last longer than just weeks. And after that, Trump will reconsider to continue the war against Iran or not.
Let's also listen to Professor Shin's diagnosis of the situation. Then, Professor Shin, if we look ahead, how high do you think oil prices could rise if this situation continues and this traffic through the Strait of Hormuz remains?
Yeah. Everybody, I think, remembers, right after the war, Ukraine and Russia in 2022, when, the kind of a conflict was very heightened, the price of crude oil in terms of Western Texas Intermediate, it did not go over $115. And it came down very slowly. And right before the Iranian war, this March, it went down to $55, and then it picked up to $100, just over $100. So I think even though, the conflict right now between Iran and the United States continues for a while, I think the crude oil price will not go over $100 and possibly between 85 and 95, and it will not stay very long at very high levels. So I think, as Professor Song had mentioned, I think the conflict will not affect crude oil prices as much as it has been in 2022 or right after the Iranian war. So I think it will quickly come down to $80 and $90. So I don't pretty much worry about the crude oil prices.
Not too much of a serious situation then. But as for now, it has risen, though. If we turn to South Korea, higher oil prices actually mean higher import, transportation, and production costs as well. How much of a burden could this place on the Korean economy?
I think, kind of the media has been kind of has made people too much worry about inflation. Okay, let me point out the fact. Okay, last year we imported $80 billion worth of crude oil, $80 billion. That is about the 13% of total imports, but just about 4% of GDP. And in consumption basket of the household fuel is about 3%, and transportation fuel is about 4%. So altogether, it is about 7%. So even though the crude oil price goes up, let's say 20%, it's going to have a very negligible effect upon at least in inflation. So I'm not worried too much about inflation because the Iranian and United States conflict will not stay very long, and also will not have a significant impact upon the crude oil. So the effect upon Korean inflation will be very limited.
We will certainly hope for that situation. But what about Professor Song? What is your opinion on that? The won is trading near 14.90 against the dollar, and higher oil prices and weaker currency. Do you think another wave of inflation is coming to Korea?
Because of the exchange rate, there is an impact on the inflation. As Professor Shin has mentioned, I do not think much of it. But what I'm concerned right now is currently, considering the size of exchange rate based upon the purchasing power parity, Korean won should be $1 is going to be equal to 787 point some won. So that implies that clearly Korean currency was underpriced. So this is why particularly Goichi Hamada, who used to be an advisor to the Prime Minister of Japanese Abe, actually he advised the Japanese, when he was an advisor to Abe administration, he has mentioned lowering the interest rate. But whereas right now, for the current Takaichi Prime Minister, he thought the currency value should be increased. I mean, in terms of value, so the number of exchange rate will be reduced against the U.S. dollars. So that implies that would be better for Japanese economy. I believe this is also true to the case of Korea. So considering clearly Korean won is underpriced against the U.S. dollar, so that means there is not much pressure in the long run the exchange rate to rise or increase, so decrease the value of Korean won. However, recent fluctuation or volatility of the exchange rate is mostly due to some kind of capital market flow in and flow out. So considering the situation in Korea right now, the SK Hynix and Samsung Electronics has taken more than 50% of the capital markets total cap. So that is also true in the United States S&P 500. Out of there's some tech companies and SpaceX and such tech AI-related companies take too much portion of capital market share. That implies increased volatility. That means also the flow and the cash flow over the border crossing will take place much frequently. So that caused the volatility increase of the exchange rate. However, I believe in the short run, clearly there is some volatility, but in the long run, I believe that it will be declined over time and reach a little bit very close to 1,000 or 1,200 won or something in the future.
But if we look at the measures by the Korean government to tackle the situation, the BOK has recently raised its interest rate, and President Lee has suggested extending or even strengthening the government's fuel price cap. How effective do you think are these measures in containing inflation?
Yeah, recently the chairman of the BOK, the Shin Hyun-sung, has increased the interest rate from 2.5% to 2.75%. But that is a very, I believe that is some kind of not strong signal, but BOK is ready to respond. He would like to deliver such messages to the market. And also, that does not cool down some kind of economic growth rate, because I believe that economic growth rate is mostly supported by the increased export and also government investment. The problem is recent surge of the capital markets share value increase does not transfer to the increased consumption in the economy. That is a typical K-type development and the K-type growth. So the consumption does not help much grow the GDP growth rate. So that is the problem. As a result, consumption inflation does not affect. That is not the primary reason we increased the interest rate. However, because of the concern of the exchange rate, that's why my BOK chairperson has increased the interest rate. And also that could have a little bit negative impact on the growth rate, but for the GDP growth rate a little bit. But as the market cool down, in the capital market cool down, then we are going to see how it will play out for the economic growth rate of the Korean economy, particularly. There is some optimistic, but I don't think this year's growth rate is reached 2.8%. Only very optimistic view is 3.0% or higher than that, but I don't think so, because despite the Iran and the U.S. war has ended almost immediately, not much good news is available for the general people's consumption. That is the problem.
But we'll have to see how the results of this latest rate hike would have. Now, when we go back to the markets, Kospi has bounced back above 6,700, led by strong gains in the semiconductor stocks. Professor Shin, do you see this as the beginning of a sustained recovery or just a temporary rebound?
Okay, today it went up 3.6%, but yesterday, you remember, it went down 4.5%. Last week, up 66.4% and down, 6.2% and up 0.7% and down 9%. So, the trend is very clear. I want to make this point to the people who are interested in Korean investment, stock investment. For the month period, since the middle of June till today, general tendency of Kospi is very clear. It came down from 9,200 to 6,700. So this is a general trend. So it cannot be called sustained recovery, or it's just a temporary, kind of a fall. So I'm really worrying about how far it could go down. Would it stop at 6,500, or would it go down below 6,000? I think that is most important issue for Korean investors.
Right, so we're still seeing a lot of volatility in this market. But if we look ahead to the U.S. earnings situation, Professor Song, major tech companies are expected to release their report this week. What do you think investors should be watching for to determine if AI and semiconductor demand is still strong?
This is also true to U.S. capital market as well as Korean stock market, because stock market index is not a very useful or reliable indicator to be used as a gauge whether the economic growth rate, how it will affect the future long-run consumption and growth rate. Because as Professor Shin has mentioned earlier, we have witnessed a very huge volatility, more than 30% within weeks. This is not a good, robust stock market at all. So the primary reason is because readily affected by the small number of stocks in Korea as well as in the US. So despite the very good news and the high report of earnings in the US market, we should not consider this is a general tendency for the US economy. The growth direction or the South Korea's economic growth direction at all. So we must be very cautious. However, what is important is to maintain the current level of growth rate as well as make the people consume more. Otherwise, people would like to make a saving, not in the bank, but in some commodity markets such as the stocks. Very speculators would like to prefer that, but very risk-averse investors would like to purchase some kind of a very fixed and reliable commodity. For example, a good example of real estate, definitely. Mm-hmm. So that is not at all healthy support or foundation on which the economy to grow. So right now, South Korea economy needs not a very big growth rate, but we need is risk management, how to deal with the declining capital market, and there must be an adjustment in the capital market also, as well as we are going to deal with some real estate markets. So then we need to support the general people's consumption to keep up and to support, sustain the current economic growth.
Right, a very important point indeed. But now that you've touched upon the real estate market in the nation, let's also talk about Seoul apartment prices. It has been continuing to climb recently despite higher interest rates and tighter policies on lending. Why haven't these measures cooled the market, Professor?
Actually, when we focus just only Seoul area, then we are going to be have some biased view on overall economy. So clearly, in Seoul is one of the most attractive city, and therefore it is natural the real estate price to go up. But however, how to cool down or too much increase of the real estate price, particularly in Seoul metro area, is the only way I believe is the supply. The reason and the key point is how to keep the supply, because usually the real estate such as the residence apartments cannot be built up immediately, and also we cannot keep the large stock of the inventory to be used for the future at all. So that is the real difficulties lies in ahead of the government. But government must navigate, maneuver through that difficulties. But one of the most important is there is a very some kind of defined schedule of supply, not just a surprise signal to the market. That does not help the real estate price stabilized at all. So to that regard, I believe that supply is the key point, but however, it will take long. Therefore, maintain the current tax system and interest rate, just the 25 basis point increase does not much affect the mortgage rate, but we need to keep up the supply of in the several forms of housing for the youngsters and for the old generations as well.
Right, indeed. It's a very tough, complex situation right now. But what about Professor Shin? Before we leave you, before we conclude our discussion tonight, so we're ahead of this government's real estate debate. What kind of policies do you think is really necessary to, help this current situation?
Well, you have to remember, you have to remember when the housing prices has been picked up. That's the end of 2024 when the Bank of Korea, decided to lower the rate significantly throughout 2025. That has kindled the housing prices. So as the rate go up, 25 basis point, and the governor promised he will raise it furthermore. So as long as the rate go up 25 basis point more, or possibly 50 basis point more, 2026 and 2027, I'm pretty sure that the price of housing will die down. So I think the key factor in the short run is the rate of interest rate, and without adjusting, rate hike, it's going to be very difficult to, fight the housing prices. So I emphasize, the rate is the key problem.
Right. So all in all, it seems like a housing supply and the interest rate. It would be interesting to see how these policies would play out in the months ahead. But as for now, we'll have to leave our discussion right here tonight. Thank you so much for your insights, Professor Shin.
My pleasure always.
And of course, our Professor Song, we really appreciate it.
Yeah, my pleasure also.
And that'll be all from us on Within the Frame tonight. Be sure to tune in again next time as we continue to explore the stories that matter. Till then, stay informed and engaged.